Hello, everyone, and welcome to another edition of a virtual investor event hosted by NZX. My name is Doug Vrame, and I'm with the Capital Markets Origination Team here at the Exchange. We've got two presenters today, which we'll get into in a minute. But before we do, I'll just kind of run through the format real quick. Each presenter will have about 15, 20 minutes to present, and then followed by Q&A. And we really encourage you to ask questions if you can. The way you do that is by going into the control panel of your webcam, and there's a chat function, and you can just type in questions. They'll come to NZX, and we'll filter them through to the speaker. So please do if you have questions. If you have questions we don't answer, we'll send them out later, as well as a recording to the whole presentation. So let's get started here with our first presenter, which is Kiwi Bank. We've got Steve Jurkovic here, who's the CEO of Kiwi Bank. Steve joined them in 2018 as the CEO, graduated from Otago University, and has 20 years of banking experience. So we're very glad to have you here, Steve, and I will turn things over to you and then join you back for questions at the end. So take it from here, Steve. Thanks.
Great, thank you. Just 2 seconds. Hopefully you can all see me.
Yep.
The usual disclaimers is participants, you'll all be familiar with what I'm going to give you as a bit of an overview. So sort of starting position, I guess, is just a quick run through on Kiwi Bank and who we are. For us, one of the anchoring foundations for us as an organisation from 22 odd years ago is that we were formed with a purpose, which was that Kiwi would be better off if they had their own strong, independent, locally owned bank. And one of the great things about leading the organisation is that purpose remains as true as it ever was. So Kiwi making Kiwi better off is our founding purpose. That is the anchor that we really try and drive things through. One of the things we try and make sure we stay focused on is that we believe that we can deliver performance through purpose. And I don't think there's many other banks that can say that they're anchored on that single view of that New Zealand is better off if they have a high performing bank that they own. Our ownership structure is pretty straightforward. In recent times, the New Zealand government became the 100% owner. They have a holding vehicle, which is Kiwi Group Capital. That is the holding company. It has ourselves as Kiwi Bank Limited and New Zealand Home Loans. By shape of assets, Kiwi Bank is overwhelmingly the largest asset in the group. We are obviously domestically owned, so every single one of New Zealand's citizens owns us. We're around $33 billion in assets as at 30 June. We're a nationwide retail bank. We target particularly personal customers and business banking. A couple of the areas we're not in, agri and institutional banking. I have worked in those areas previously. One of the reasons we choose not to participate in that market is that we believe that New Zealanders are well served by 5 big banks in the agri market. And at the institutional end of town, there's obviously the Australian-owned subsidiaries that operate in New Zealand, but also international banks offer the institutional banking requirements. So for us, we think we stick to our knitting. We are a pretty vanilla retail bank. Those are by far the largest value pools in the New Zealand marketplace, being personal banking and business banking, and we've grown pretty strongly, and I'll touch on that in a second. As I mentioned, we've got a founding vision, and I think very clear in recent times as we've rebranded to try and think about what New Zealanders want in their own bank. And what was really obvious was they wanted a credible, vibrant New Zealand bank that actually reflects who we want to be as Kiwi, and we think we've done a reasonable job of rebranding there. And it was really pleasing to pick up a couple of the effectiveness awards in marketing and New Zealand marketing awards around the rebrand. It certainly was a very significant piece of work, the largest that Kiwi Bank had done in its history, and so we think that's been part of the reason we've reignited our relationship with New Zealanders and grown pretty strongly. This is our strategy on a page, probably nothing there that you wouldn't expect to see from a bank. Our purpose, as I mentioned, Kiwi making Kiwi better off. What are we trying to achieve there? We call these our purpose pillars. They are to make our tamariki better off, to make Kiwi better off, and making Aotearoa better off. We do that through providing access to financial education, like Banker is one of our great partnerships. Taking action to secure your financial future is how we think Kiwi are better off. And then Aotearoa are better off if we help and support sustainable finance to improve Kiwi businesses. Our goal is really simple. It's to be the customer's first choice I like that because what it does is anchor us in a competitive market and recognise that, you know, we have to compete and earn business from Kiwi, and that's what we try and do. So that we want them to prefer us for their banking needs and choose us for their home lending and business needs. Obviously, tying back to the main focus areas of our business. Our offer, 100% focused on trying to be simple, easy, accessible, and deliver the right expertise. And we think we're a better bank when we sustainably grow. We have an impact about being a purpose-led employer. We're trusted. People believe that they're going to get a good outcome with us, and that we take ownership and act quickly, and that's what we mean by empowered. All of this is anchored on our 4 beliefs, which we call our ngā kauwaka. And in Te Reo, that's an interpretation of kauwaka is a mindset. And so we have 4 of those: a place to belong, where we rise to the challenge, we're better together, and we've got the customer at the heart. And those 4 mindsets were created by our organisation for our organisation off the back of 1,900 odd conversations we had with our team. Some sustainability, I'll try and get it right, sustainability highlights. So reduced our carbon emissions, nearly 60,000 students use Banker, which is the financial education platform. We've improved our cards. We've gone with Kogo carbon management, allowing our customers to understand what their footprint is. We're lending more money than ever into sustainable finances. We've got our own wellbeing program. We're pleased with where our culture is. That's a journey that's never finished, and we've helped a lot of customers through some pretty tough times. And so, you know, I think all of the banks can be pretty pleased with the effort they've made to try and support the customers. If I think about the lending portfolio, we are primarily a retail mortgage bank, 7% share of the mortgage market. We do a bit better than that most months in recent times. But as you can see, if you look through our lending category, home loans, credit cards, overdraft, business lending, that makes up the $30 billion of business we do. Overwhelmingly, as you can see in the home loan portfolio, 24 odd billion. 92%, 8% fixed floating mix, which is very much the New Zealand norm. Average home loan balance a little bit smaller than some at 385. On interest only, 16.5%. That's sort of ticking up a little bit, and I'll touch on that in a second. And actually a very small percentage of customers at an LVR over 80, obviously driven by prudential rules from the Reserve Bank. Think about our asset quality. We've been the standout performer in the quality of our assets. So while we've had a small increase across the banking system, we've got no indication that we're seeing significant increases in credit stress. Although every single day that we're higher interest rates for longer, more customers find it tougher with cost of living, but aren't seeing any sort of really sizable shift. Our impairments compared to the other banks, as you can see on that graph on the right, actually very low. And I think just talks to the fact that we've done historically a good job of picking which customers are right for us and we're right for them. And if you look at impaired loans, you can barely see us there on that space. That's partly to do with business mix versus other businesses that we compete against, but overall we're really thrilled with that. Speaking of sustainability, the lights just go off, won't be 2 secs, hopefully. Here we are, we're back. If you think about our financial results, you can see there that our profit's really been underpinned by net interest income, so profit after tax, increasing nicely as far as we're concerned. Think about the prior periods. The higher revenue, as I say, really anchored in net interest income. That's up 26% from the prior period. Strong lending growth has helped that, but also a rising interest rate where we sort of normalised how we could work on both sides of the balance sheet to support our customers and grow. Cost to income ratio is calculated as per the Reserve Bank. One of the things we have done is really significantly invest in our technology to improve our overall outcomes. We believe we've done a good job of keeping our underlying cost to income, you know, under what we think is pretty strong control. But likewise, we've also invested much more strongly into our operating platforms and our people. So we're a much better bank than we were a few years ago for that. But also, I think, you know, it's going to give us a sustainable opportunity to reduce cost to income over time. And if you think about peers, there's certainly a lot of room for us to move cost to income down as we grow with more scale. If you think about that goal of being the customer's first choice, I think this graph does a reasonable job of explaining that. If you think about the green line versus the system, which is how the overall credit market and total lending has been growing, you can see there that the green bars do outperform the system very consistently. And we think that's a good way to think about performance, because ultimately, you know, the lending appetite of the New Zealand customer base will be what it will be. So we just need to perform as best we can against our peers and against that system. And so, I think we've done a good job there. Likewise on deposit growth, that's probably one of the keys to our performance, is that we have managed to self-fund significantly through deposit growth. So residential mortgages has grown by over 1.5 times the system, but we've also done very well in business banking. Still a smaller part of our base, as you would have seen earlier, and still very big opportunities in business banking. And what we're finding is New Zealand businesses are keen to bank with a New Zealand business. If you think about funding and capital, we've got a key focus here. This is the requirements for the Reserve Bank, which tick up over time. So we are well ahead of the regulatory requirements and still running towards that 1 July 2028 transition date. What that means is that we're very unlikely to be paying a dividend while we're growing our capital base, and that's well understood by our ownership group, and is obviously a little bit out of our hands because we want to grow and also obviously stay well ahead of those capital requirements. Recent injection of $225 million from the Kiwi Capital Group, our holding company, was one of the conversations that the rating agencies had been looking forward to, which is they have always given us a strong support that we would get the capital when we needed it. But likewise, like most of us, it's good to see that actually happen, and that is what happened, and that was done on 31 July. So that added about 1.3% to our capital ratios, as you can see there. If you think about the funding mix, pretty straightforward picture there. I think we are in a stable situation with Fitch and Moody's, as you'd expect, and I think are probably looking for. Mixture of offshore, long-term domestic, short-term offshore and domestic, as you would expect from most banks. But we're really pleased with the funding mix that we've got and the maturity profile. If I think about, if I just escape from that, come back to you. One of the things I guess that we really want to touch on is the situation that we think is, probably the one that people are most interested in, is the situation which is our customer base being supported as we think about higher interest rates for longer? And the short answer is, yep, absolutely. We did about 5,500 calls over the July to September period. And through that period, what we were trying to do is make sure that customers knew that they were well looked after and well supported. What we found in that situation was about 5% of the customers actually wanted to talk to us about what they could do. So 5,000 became sort of about 500 people wanted to get involved in some sort of a conversation. From that, about 300 wanted to go to interest only or extend a term. Only about 40 or 50 of those were interested in really working through a specific hardship situation. So if you think about 5,000 calls becomes 50 in the sense that they are wanting to either have a break on payments or do something else. It actually, I think, profiles that New Zealanders have been pretty resilient, and they've made choices around where they want to cut their cloth in terms of supporting their mortgage payments, which is understandable because the number one need when we ask customers about financial security is a roof over their head. And so, I'm very confident that New Zealanders will do what they need to do to make sure that they can stay ahead of the situation that they need to be in order to keep themselves afloat and look after their mortgage. That's probably been the number one story across the market. The market study so far has been reasonably benign. We're still in the information request. So if I think about headwinds for the industry, far less likely, I think, to be a focus for Kiwi Bank than, say, some of the larger organisations that are announcing very large profit numbers. And so we'll wait and see what happens. Obviously, some uncertainty without a government being formed at the moment. I guess most of us would have been coming into this call hoping by now we'd have a bit more clarity. We don't think there's anything in store for us as an organisation with Crown ownership. The messages from the major parties, Labor had supported 100% purchase by the Crown. National didn't signal anything that they were interested in relation to that. So if there's an open question around, our influence around the Crown and those choices, we certainly don't have anything to update market participants on or investors in that relation. So very much business as usual for us. So I thought I might stop there, and if there is questions, I'm happy to take them.
Yeah, thanks, Steve. I appreciate it. There are a few questions around, I guess, kind of like how you spoke to it a little bit, but how you see things playing out in a continuing high rate environment. And you mentioned you had reached out and talked to customers about hardships and things like that. Do you guys expect I guess on the New Zealand economy as a whole, that type of stuff to increase, and looks like your average loan balance is a little bit lower than some of the other banks, so maybe you're protected there. But do you see that as something that's going to be taken advantage of more, or more of a concern for the economy?
Yeah, I mean, I think what we're seeing, and if I look around, Auckland and Wellington, where I spend most of the time in this role, what I sort of see, I think, is people making decisions around how much they spend on hospitality and things like that. So I think, where they can go to make choices, to make savings, I think hospitality is feeling the brunt of people dialing back and maybe eating more at home. I think the durable goods like televisions and those sorts of things, I think people are probably putting some of those purchases on the back burner, maybe new cars and things like that. So I think some of those choices that are much more around the discretionary area, Doug, are the ones that are feeling the pinch the most. Look, I would expect that more people over the next year will take advantage of some support from the bank. I guess it's worth bearing in mind about 20% of our customers are well ahead of the minimum requirements. So over time, where interest rates were low, often they didn't drop their repayments, and that's meant that they can move forward being ahead of the game. And so there's a lot of that flexibility around. Also the banks, I think everyone's in the same situation, which recognises that there was a really material uptick in interest rates, unprecedented really, but the net level overall, if I think about being in a senior leadership role in banking for the, say, last 10, 15 years, the interest rates we're in now are probably closer to the norm than those very low interest rates were. And so we were testing customers at sort of 7.5%, 8% when they were paying 3%. We're now testing them at 8.75% mortgage rates. So, those customers that could show that they could afford things at 7.5% can afford things at 7.5% and are doing so. So, while I think those test rates might have been seen as pretty academic at the time, they've also proven to be a pretty good test of resilience. And as I say, look, I think people just make choices and recognise that actually, a bit more bounce in the property market probably makes people feel a little bit more upbeat. Hopefully some better weather coming. So those things I think are sort of natural adjustments. But I expect that, we will be in this sort of operating environment for 18 months, I'd say.
Yeah, interesting, good. We do have some more questions. I'll ask you one more and then we can send you some. But a couple of questions about what you guys are doing and what you see in terms of countering scams and frauds that are going on today, and how you're dealing with that, or are your customers being affected by that?
Yeah, look, I mean, it's probably the #1 topic across the industry. I sit on a weekly meeting with the 5 biggest bank CEOs, so that gives you a bit of a feel, which is all 5 of us meet for between half an hour and an hour once a week. There's a number of initiatives underway. So we are co-funding an anti-scam centre, which sort of modelled on the Singapore anti-scam, which is cross-industry, but also across other participants like telcos, police, CERT, GCSB, because it is a whole ecosystem problem. And so telcos, Spark, 2 Degrees, One New Zealand, all very active in participating. Police super keen to see the support and the expertise. Each of us is really upping our game in terms of the way that we work with MasterCard and with Visa, which cover, the vast majority of the participants in the market. So they've got global expertise that we're all leveraging. You're starting to see people drop the text messages across the industry, and really trying to create a situation where, unprompted text messages aren't arriving from the bank. That's a work in progress and still working on that. We are working on account matching. So that's the difference between, say, getting an invoice with an account number on it and making sure that it is in fact Doug. There's a bit of devil in the detail about that, because, if it's D versus Doug versus Douglas, we can easily get false positives. And in England, that's the situation that really slowed payments down. So none of these are a silver bullet. I mean, I think in the famous words of Horowitz, the VC guy, we're going to fire lots of lead bullets rather than a silver bullet to fix scams. What I have to say is that it's a bit like cyber in the sense that the threat capability is really distributed and is growing really fast. And, everyone on the call should be rest assured that everyone from government, board, police, regulators, FMA, the lead agency on this, there is a lot of intensity around trying to help people, recognising that customers can feel really distressed and feel really exposed in these scam situations. And, there's sort of 8 or 10 flavours of the different scams, from the traditional romance style to person in the middle. It's a really complex situation, but we're certainly bringing all our best and brightest to work on it. And it's probably, I think you saw in the Westpac results, they talked about how many people they'd put into financial crime. We're in the same boat. We're investing in that as fast as we can, but it's a hell of a race to try and defeat that situation.
Yeah, amazing, interesting, and great answer. Appreciate you talking about that. So we'll get you some more questions and shoot them out to the audience. But Steve, thank you very much for joining us and the patience on the pickup at the beginning. And yeah, great presentation. Appreciate it. So thank you.
Thanks, Doug. Cheers.
So now, as soon as he joins us, hopefully this is all going good. We will.
Yeah, can you see me all right there, Doug?
Yeah, absolutely. So just a quick introduction now. We've got, I'll hand it over here in a minute to David Grace, and David is a portfolio manager for the Australian Foundation Investment Company, and they are a investment company that focuses on Australian securities. Typically have about 75 securities in the portfolio. Try and focus on companies that can withstand business cycles. Are listed on NZX under the ticker AFI. So David has been with them since 2018 and has good portfolio management experience. Concisely in 2007 and has a lot of experience. Thank you, David, for joining us and talking a little bit about the portfolio and economy and all that. And I'll turn it over to you back with questions.
No problem at all. Thanks, Doug. And yeah, good morning, everybody. So just a little bit about our company. If we just onto the next slide there, please. So there's a disclaimer at the front, just on to the next slide, which has just got the heading there about our company. That's one, thank you. So Australian Foundation Investment Company, or AFIC, was formed in 1928 and it's Australia's largest listed investment company. So we invest in both Australian and New Zealand listed securities. So that's through the full spectrum of the market cap, from stock 1 all the way down to small caps. Shareholders own the management rights to the portfolio, and the management expense ratio, as you can see in the middle there, is 0.14%, and we charge no performance fees. So what that means is for every $100 invested in our company, you're paying 14 cents in a management fee. So in terms of our approach, we're a long-term investor. We aim to be low turnover, and we focus on investing in quality companies, and we have a long history of stable to growing dividends. So on to the next slide. So this outlines our investment objectives, and really the primary investment goals of how we're managing the portfolio is to be able to pay a dividend which grows over time. And then secondly, as long-term investors, we aim to provide attractive total returns over the medium to long term. On to the next slide. So by drawing down on profit reserves, we're able to maintain a stable to growing dividend throughout volatile times. So what we've shown on the chart here is the experience of the dividend that we paid throughout the recent COVID period. So as you can see, starting on the left-hand side, our earnings per share, which is the income or the dividends that we receive from the companies that we invest into, that declined from 22.7 cents in 2019 to 16.3 cents in 2021. And that really reflected just companies cutting their dividends as they went through a pretty uncertain economic environment. So despite that, we're able to use our profit reserves to be able to maintain a dividend of 24 cents per share throughout that period. And in fact, in 2023, we're able to increase our dividend to 25 cents per share, as you can see on the far right-hand side. Next slide, please. So this chart just shows our share price history over the last 10 years relative to our net asset backing. It's a really important metric that shareholders could look at when investing in any listed investment company. We always like to call this slide out as it gives shareholders a good indication of whether or not they're buying value at our current share price. So you can see towards the middle there in 2022, the share price to NTA got to a premium of around 15%. Effectively, shareholders were paying around $1.15 for $1 worth of assets. At the end of September this year, as you can see on the right-hand side, the share price was $6.87 and our NTA was $6.97. So at that point, we are trading at a 1.5% discount to NTA. So we release our NTA figures to the ASX and the NZX on a monthly basis. We really recommend shareholders have a look at those releases just to get a sense of whether or not the share price is trading at fair value relative to the NTA backing. Next slide, please. So just a little bit about our investment process. As I mentioned earlier, we're long-term investors in quality companies. We're not looking to trade short-term movements in equity markets. We believe the quality of a business is the one feature that can survive or can be sustained over our medium to long-term investment horizon. So we really focus our research effort on developing a deep understanding of a company's key characteristics, specifically the attributes we believe will enable a business to deliver meaningful earnings growth over the long term. So the key things we look for are companies that hold a strong industry position. They're run by strong management teams and boards. They have sustainable business models over the long term. They hold unique, difficult to replicate assets, have a definable competitive advantage, and most importantly, they have a really strong balance sheet, which just gives companies the ability to be able to self-fund their growth profile as they try to capture the growth that we see in the long-term opportunity. So we want to be able to identify these companies and add to our holdings when they represent value. We really seek to benefit from the power that compounding returns provide to long-term shareholders. So on to the next slide. Thanks. So the slide here just shows portfolio performance relative to our benchmark, which is the ASX 200 over various time periods. So I mentioned we're low turnover, and accordingly there'll be periods where we'll underperform the market. However, over the long term, the core of the portfolio will remain invested in high quality companies that we believe have strong growth prospects. So for the 12 months to the end of September, the portfolio was up 12.4%, while the ASX 200 delivered a return of 13.5%. Returns for the portfolio are shown after tax and expenses, and for the 1 year period, that was a drag around 0.3%, which clearly that's not reflected in the index numbers. So just a couple of things to point out in relation to the 12-month performance was firstly, pullback in share prices of number of high quality companies, and namely, so Transurban and ASX, which we invest into. We still believe the fundamentals of these companies remain strong. That had a good period for the 2 years prior to last year. We've actually added to both of our holdings in recent times, given the recent pullback. And then secondly, as the chart on the right-hand side shows, this is the sector performance over the course of the last 12 months. You can see that utilities at the top there at 34.9% and energy at 23.1%, both materially outperformed the ASX 200 return, which is at 13.5% towards the bottom end of that table. So both sectors really benefited from supply chain disruption as we saw Russia invasion of Ukraine and led to a strong spike within energy prices, which clearly led to performance of both of those sectors. Now we recognise that companies in these sectors are highly cyclical. It's really driven by the underlying commodity price. As I said, we're not short-term traders in share prices, so we're underweight both of those sectors when we take our long-term view. Of note on the right-hand side is just the performance of healthcare over the last 12 months. As you can see down the bottom, healthcare was down negative, so 6.5% for the last 12 months, materially underperforming the market return. And in that sector, we have quite meaningful holdings in CSL, ResMed, and Fisher & Paykel Healthcare. We remain confident the long-term opportunity for all these companies remains really, really strong. We've actually been adding to our holdings in recent times, and that's really been the disruption in the share prices for all these stocks, really around the threat of weight loss drugs. And we see that may reduce the addressable market for all these companies in a small degree. We think it's manageable, and we think they all represent good value where they're trading at the moment. So on to the next slide. Just a recap of market conditions as we're seeing currently. So equity markets really facing a period of uncertainty really around where the future of economic growth is going over the next sort of 1 to 2 years. So if I look on the left-hand side there, on a positive side, recent economic growth, while it has remained solid, the market is concerned about where that heads from here. We see China policy initiatives attempting to stabilise market conditions appear to be working at this point in time. We see the Australian market particularly being supported by immigration, with over 500,000 people coming to Australia in 2023, and projections are for that to be a higher number next year. On the negative side, inflation remains elevated. We saw the RBA raise rates again yesterday. Consumer spending is starting to slow. It's been relatively resilient, but early signs that it is starting to weaken at the moment. And earnings growth for many companies, we feel, is set for a period of stabilisation, and that's on the back of really strong earnings growth that have been supported by government handouts, particularly to the consumer. We feel they're now coming to an end, and it's really hard for companies to be able to keep pulling the price lever. So feel that earnings growth is starting to stabilise, a lower rate of growth than what we've seen in recent times. So markets are always forward-looking and always looking to attempt to price what's next. While we don't know how all the current issues ultimately get resolved, we remain committed that holding a diversified portfolio of quality companies over the long term remains appropriate. We know periods of opportunities ultimately provide the best buying opportunities. And just times like this, we need to undertake extra diligence in terms of the valuation of what we're prepared to pay. So over on the next slide, just expanding that out a little bit further. So in managing the portfolio, we look to own a diversified portfolio of quality companies which can outperform in a variety of economic settings. We're not predicting economic outcomes. We seek to own quality companies that own appropriate diversification. So we want a mix of growth companies, as shown in the top left-hand side there, and these are companies that hold market leadership positions where we consider the long-term growth prospects remain strong. So that's the likes of realestate.com and CSL. We want stalwart companies over the right-hand side. So these are companies that own difficult to replicate, highly strategic assets, really well positioned to deliver long-term earnings growth. So that includes the likes of Transurban, Wesfarmers, Auckland Airport and Woolworths. We want income stocks. We recognise that attractive dividends play a really important role in the total return that shareholders receive. So in this basket, we have our exposure to the banks and Telstra, for example. And then on the bottom left-hand side are the cyclical companies. So these are companies that are favourably exposed to positive economic growth, is what we see over the long term. And all these companies maintain strong balance sheet. So we classify our holdings in the energy sector there, both Santos and Woodside, in the cyclical basket. Both these companies predominantly produce LNG. We see this as a critical transition fuel as the world's energy needs move from hydrocarbons to renewable sources. And we see this transition being many, many years away. So both companies have committed meaningfully to reduce their carbon footprint. And it is certainly our view that these assets are best held in the responsible hands of Santos and Woodside, who are committed to reducing their carbon footprint. The other point I'd note is just post recent mergers for both of these companies, the balance sheets remain in really strong shape, and they're able to self-fund the growth profile that they have in front of them. So on to the next slide. So this just shows recent transactions that we've done in the portfolio really over the last 6 months. So again, we're not short-term traders, but we do want to make sure we're capturing buying opportunities when they present in those companies that we consider to be quality with good long-term prospects. So on the left-hand side, we show stocks that we've reduced or trimmed during the period. We trimmed our positions in car sales, Transurban, Main Freight, NextDC, Woolworths, Brambles and REA, and really where we felt valuations became quite extreme for a lot of these companies, or we wanted to manage the size of the position as they go through a period of uncertainty. We still maintain a holding in all these companies, albeit less. So the decision down the bottom left-hand side there to exit InvoCare, Ansell and Iris really reflects our view that the long-term prospects and returns for all these companies are increasingly more challenged. And handy for us during that time, InvoCare was in receipt of a takeover offer, which enabled us to get out of that one at a good price. On the far right-hand side, we just show companies that we've been adding to in recent times and really using the volatility, as I mentioned earlier, just to add to some of our preferred holdings. So that short-term share price weakness allowed us to add to Goodman Group, CSL, BHP, NAB, ASX, Telstra and IDP Education. So the banking sector remains a really key source of income for our shareholders and becoming increasingly important in terms of the income they deliver to the portfolio, as we've seen the iron ore price roll over and both BHP and Rio reduce their dividends quite materially at the recent reporting season. On to the next slide. Oh, sorry, so we go back, sorry. It's just the middle column there, the new purchases column. We've actually recently added one stock to the portfolio, which is Mineral Resources. And that was following share price weakness, where the share price had rallied up to around $100. The market was getting very excited about the potential for lithium towards the back end of last year. And we've seen the share price come back to something more reasonable in recent time, down to below $70, so we've added to that. So Mineral Resources are an Australian mining services company, and they're also a producer of both iron ore and lithium. We particularly like the lithium thematic, given the strong demand from electrification. Importantly, we saw the change in the business strategy is a real positive, where they've looked to do long-term contracts directly with the OEMs or the vehicle manufacturers, just to be able to lock in long-term demand for their lithium offtake. So for us, it's an owner, founder business. Chris Ellison is the CEO. He founded the business many years ago. He continues to own 12% of the equity, and it's a unique opportunity for us to be able to co-invest alongside the founder of the business. And then on to the next slide. So just in terms of outlook comments, so as we earlier discussed, there are a number of threats and opportunities for companies that are occupying our mind. We're maintaining regular contact with the companies we're invested into, just to understand how they're navigating through a more volatile environment. We remain committed that those companies that have market leadership, they're really best positioned to be able to pass through rising costs to their customers, and strong balance sheets remain critical in this environment, particularly as we've seen such a sharp rise in interest rates in recent times. We feel our approach to maintain a diversified portfolio remains appropriate. We feel the portfolio is well positioned in a wide range to outperform in a wide range of operating environments, invested with a mix of companies displaying income and growth attributes, really well positioned to deliver long-term earnings growth. So that's sort of concludes the presentation. So happy to throw back to you, Doug, and answer any questions.
Nice. Thanks, David. Appreciate it. Thanks for going through that. We have some questions. I'll kind of just throw out a few topics here. One that has come up a couple of times is around the dividend the portfolio pays, and you guys have kept it stable. How do you determine when and how much you change that by?
In terms of the turnover of the portfolio?
Oh, in terms of the dividend payment.
So the dividend payment, so really that's dictated to by the dividends that we receive from the companies that we're invested into. So our commitment to shareholders is to have a stable to growing dividend over the medium to long term. And there'll be periods where companies cut their dividends, as we saw through COVID. We saw that through the GFC in 2007 and 2008. Fortunately, we've got the ability to top that up through reserves, as we showed on one of the slides. But typically, in normal markets, you'll see companies increasing their dividend payment in line with earnings growth. And our focus on quality companies, we feel are really well positioned to continue growing earnings. So as we receive that income from the companies we're invested into, we look to pass that on to shareholders in the form of growing dividend.
And then there's a couple about do you guys have any thoughts or outlook on the New Zealand economy versus the rest of the world, or relative to Australia, and any opportunities you're seeing here specifically in sectors or areas?
Yeah, I think it sort of goes back to the earlier presentation. I think we're really cautious around where the consumer's at. I think this is a global thing, but particularly for New Zealand and Australia, is just how resilient the consumer has been. And when you see interest rates rise to the degree that we've had, I mean, that's kind of the fastest on record, if not all time, certainly close to. The ability for the consumer to wear the increase in cost of living is something that we've been really surprised at, and something that we're really cautious on. So, you know, they're the areas that we're focused. We're certainly not looking to add to any companies in the consumer discretionary space. our view is that while markets overall are pretty much fair value, there are pockets within markets where we feel earnings growth is going to be more challenged, and it's those that are directly exposed to the consumer where we feel they're going to be front and centre of that. So that's the area. We haven't seen necessarily large signs of weakness at this stage. I think, as I mentioned throughout the presentation, early signs are that the consumer is starting to slow, but we don't feel that's necessarily being reflected in share prices where they're trading.
Yep. And then do you, I guess, monitor, do any of your investments have any posing ESG concerns, or is that a big factor in the portfolio to some extent on the ESG considerations of your investments?
Yeah, we do. So we're not running an ESG fund specifically, but if you think about our investment time horizon, every investment we make, we really look at a 5 to 10 year view, and we see ESG concerns as being just one of the factors that can disrupt the company's ability to generate good returns over that time horizon. So it's certainly one of the considerations we have, but it's one of many as we just look to assess a company's prospects, its position within the industry, its balance sheet, and I guess its license to operate. Can it actually deliver meaningful growth, meaningful returns for shareholders? And ESG is one of the considerations that we look into.
Awesome. There are a couple more. We'll send those out and get them to everyone on the call as well. But yeah, David, thanks a lot. Really appreciate it. Great summary and information about the.
No problem at all. Thank you, Doug.
Yeah, thank you. And well, that will conclude for today. We've got just 2 today, so we'll get the note out next time. But any questions that the audience has, in the meantime, feel free to send them to us, and we'll get the link as well with the replay of the presentation. So thanks again, everyone, for joining. Thank you.